Welcome back to a brand new video brought to you by Funding Frontier and myself, Ryan Cruz. I'm a fully funded trader and have 5 years trading experience. And today we're going to be going over risk management. We're going to be looking at the risk management blueprint that top traders do not share. So stay until the end if you want to improve on your risk management game. First off, we're going to be looking at position sizing formulas that protect your capital. Before I even get into anything, prop firm 10k account is what we're going to be looking at as a base. But if you think about it, prop firms are one of the best ways to get capital. You could be one of the best traders in the world, but if you don't have capital, it's going to take a very long time to get your financial freedom, right? Now, prop firms have come about and it's been an absolute blessing for traders. It's given a lease of life to allow traders to actually get that financial freedom when they want to get it. You could be the best trader in the world, for example, only have $50 in the bank, $100 in the bank. Now, gaining 1% a day on $100, let's say, that's for $1 a day. Now, that will take a long time to compound to get to where you want to go, to provide for your family, to get a new house or a new car, for example. Whereas, take a prop firm challenge. If you are a good trader and you've got a proven strategy and you feel you are consistent, then this is one of the best leases of life. This is like a get out clause. Because all you need, if you get a 10k account and pass that, then you're looking at 1% a day. That's $100 a day. Much more of a game changer. And then you can work your way up to 25k account, the 50k account, 100k account. Before you know, if you do have a 100k account, then that 1% a day is $1,000 a day, and that is where life will start changing. Without further ado, anyway, so to start off with, one of the rules at Funding Frontier is do not miss for more than 2% a trade, which makes absolute sense, and I really love this rule. Why do I love this rule? Because it actually keeps the traders in check, keeps them disciplined. If you're risking more than 2% a trade anyway, you do need to look at yourself. You need to look at your trading plan because that is way too much to risk. I do believe between 1 to 2% is a good amount to risk. And sticking to the one rule. What's the one rule? So let's think about this. We've got a $10,000 account. What lot size are you looking to use? I use the one lot, the one rule basis, which keeps my head in check. So if you have a 10k account, you risk one lot, and you gain or you lose 1 pip. I know that's $10, right? Obviously we won't be doing that. We're not looking to get 1 pip. We're not looking to lose 1 pip. But doing the maths is really easy in your head now, because I know a 10k account, if I risk one lot and my stop loss is 10 pips below the previous candle or the current candle, then I know that I'm risking $100, which is 1% of the account. So it's really nice, simple maths. But you do need to think about how about you're thinking, but Ryan, 10 pip stop loss, sometimes that's too small, especially on gold. You might need a 20 pip stop loss. Again, you can use a one lot for a 20 pip stop loss, but you are then risking 2% of your account. You're risking $200. So again, use the simple maths. And what I would advise, especially if it's the start of your challenge early on in your trading journey and you don't want to risk too much, then 10k account, all you have to do, if you've got 20 pip stop loss, is half the lot size to 0.5. Then 20 pip stop loss with 0.5 lot, you're only risking 1% still. And again, if you need a 40 pop, if you need a 40 pip stop loss, just half it again, 0.25 lot, then you're only risking that 1% again. So using the one rule is a nice basis for you. But again, like I say, if you have a 100k account, you'll be looking to risk 10 lots, and I know that 10 pips will be $1,000, which is the 1%. So it's all really nice, simple maths if you use that one rule. Which is really nice. We'll go into it into more detail later. But if you're using the one rule and you're using just 1% a trade, you have to lose 10 trades in a row to fail your challenge, because you've got 10% drawdown rule. It also allows for 5 trades, 5% loss in that one day, which is also a daily drawdown rule. So yeah, again, I wouldn't advise losing 5 trades in a row on one day. If you've lost a couple in one day, you lost 2%, just leave it and come back the next day. But yeah, moving on. So dynamic stop loss placements. You don't always have to use stop losses, the same stop losses, right? So normally if I'm taking a trade, right, we're looking for a nice bullish move. We have created a new support, which is great, and we're looking to clean out these clear candles to the left. Normally I put my stop losses below the previous candle low, right? Because that's a safe place to put it. And if that gets invalidated, that means there's going to be a change in market structure shift in them candles in that setup. So if the previous candle low does get taken out, say we took a buy here and our stop losses are below the previous candle, if that wick goes all the way to the bottom and takes out that previous candle, I don't want to be in that trade anyway. So that's a sensible place to put a stop loss. However, you don't always have to put them below the previous stop loss. You can, with certain setups, take an impulse buy and use current candle stops. For example, we form the new support, then we form this weak bearish candle. Now, because we form this weak bearish candle, if we then break the previous wick to continue on bullish, use your stops below the current candle. Now, this is an impulsive move with current candle stops. So it varies it up a little bit, adds a bit of dynamic into your trading plan. Does it make sense to use them below this previous candle? You can, absolutely. However, it doesn't actually make sense, because if you break above and then start rejecting and start breaking its own low, you don't want to be in that trade, because that's a big sign of rejection. So manage your risk accordingly there by putting your stops below the current candle. Save yourself some pips and save yourself some percentages. Scaling in and out. So when you're using risk, you don't always have to use just 1% risk every time you press that buy or sell button. You can actually split it up. Say you want to risk, you've got a 3% trade, just for this example. You want to risk 3% in total on one trade, but you're going to split it up, right? So again, you formed new support, you're looking to take the buy. So with dynamic risk, all you have to do, wait for the candle to open, and at that point, if your risk in your strategy is to carry on going bullish, as the candle opens, you trust your analysis that we're going to continue on bullish. If the candle opens, buy 1%. So that's 1% down, right? But again, not every single trade is going to go straight into profit. We are going to have pullback. As long as we respect this previous candle low, we should continue on up with the bullish structure. So if we've already opened 1% as a buy here, we then start getting a pullback, but you trust your analysis, we're respecting the previous low, we're respecting the bullish structure. As we have that pullback, you can add another 1%. Because then, even if you get back up to the flip of the candle, you're already in some really nice healthy profits. So you've risked 2% now. We've come back up to flip, and then we start breaking the previous candle high, which is one of the biggest confirmations. We break the previous candle wick high. That's the main entry for me when I use my static risk. But we're already in 2 positions. We've added a third. So we've used dynamic risk, not just one whole lot of 3% at the break of previous wick. We're in some nice profits off the wick, off the pullback, nice profits from that candle open. And then as soon as we go into some nice profits, we can secure some more profits there. So that's an alternative way to just using static risk. If you prefer doing that, you only want to risk 1%, change the 1% to 0.33% per one. So instead of using your one lot, you can use a 0.33 one lot on your 10K account. Scaling in and out. You don't have to hold every single position to the moon. You don't have to do that. You don't have to hit a home run. This is a prop firm challenge, right? You need to get in phase 1 7.5%, and then you've pretty much done most of the battle then. 7.5%. If you get 1% in one trade, or even 0.5%, so 1% in one trade, you only need to get 7.5 trades done. Phase one complete. Now, secure partials. This is one of the biggest game changers for me in my trading journey. I've been profitable for about 3 years now. The first 2 years was up and down struggle, a roller coaster journey that everyone goes through. One of the biggest things for me, I noticed that a lot of my trades were winning trades, but I was holding them for too long up to a previous resistance, a previous support, which makes sense. But along the way, I'll just hold and hold and hold for full position. But if the majority of your positions go into a good, healthy amount of profit, there is absolutely no harm. If you've gone 15, 20 pips into profit, if that comes all the way back down to break even, you're more than likely in a rejection trade, right? But if you can catch them pips, move your stops to break even. At the break of the switch, say you've entered, you've gone into like 20, 25, 30 pips in profit, go to stops to break even, secure some of your positions. Because if you go to break even, you always want to secure some profits, right? Then you've taken that slice out of the market, let your runners run up to the next key area to the left-hand side. And then that way you're securing positions every single trade. Secure about 0.5%, 1%, 1 and a bit percent off that trade. Then let the runners run. And if the runners run to the moon, then absolutely love that. But that's not going to happen every single trade. So if you're securing partials, you're taking a slice out of the market, that means you've beat the market that day, right? So you make securing partials, making your trades risk-free. But what if you're in a trade, you're running in some profits, and then you start to see candles closing against you? So you're running in some lovely profits, you're in a nice buy, so it's buy at the break of the previous wick, and then now you get a candle closing against you. So you're in 10 pips profit, right? And then you see a bearish candle on your bullish buy, and you start seeing them closing against you, then that's normally a good indication that price is about to reverse. We may come back down, take you out of break even. It might be a sign of reversal of the whole market shift pattern. So as soon as you start seeing a candle close against you, you've already got your stops to break in, which is great. But even if you don't, and you start seeing that going against you, then take 50% off the table. And that way you're relieving some pressure, because you start seeing the markets coming against you at this point. You're still in the trade and you're sweating buckets because you're like, oh no, it's going to come and take me out break even, or it's going to come and take my stop loss. But if you've taken 50% off the table when the market is showing you that I'm going to start reversing, take 50% off, then bang, perfect. If you still want to stay in that trade, if you're still in that trade and you come back down to break even, take another 50% off the table. At that point, you've got a lot of your risk off the table. You haven't lost anything. It's just a really, really secure, solid way of risk management in the markets. The risk management concepts. So we've gone over some static risk, we've gone over some dynamic risk, we've gone over some strategies when you're in a trade, whether to take partials if you're in a winning trade, whether a candle start going against you, what to do at that point. So the main two differences is static risk and dynamic risk, right? Opening various positions or opening just one position on a full 1% or 2%. But the biggest tip from me to you is whatever risk management concept you choose, you have to stick to it. If you start messing around with different concepts and different risk management techniques, on one trade you use static risk, on the next trade you use dynamic, on the next trade you use a bit of both. Once you start messing around with the different concepts, that's going to be the point where you're going to start to see some inconsistencies. You're going to start to see your profits going in a nice uptrend, and then you're going to come down. It's going to be like a roller coaster ride, right? But if you stick to whatever you prefer the most, stick to the same plan, the same strategy, the same risk management concepts, that's when you're going to be most consistent with your profits. So that is my biggest tip from today. Managing risk across multiple positions. First of all, should you have multiple positions on different, like for example, you've got a trade on gold and then you've got a trade on GBP, JPY. Should you be doing that at the same time? In my opinion, should you be doing that? No. I solely believe that focusing on just one pair, mastering it, is the best way forward. And then you're also stressing that, oh, on this trade on gold, I'm in profits, and on the other trade, on GBP JPY, I'm in drawdown, and then in your head it just creates an absolute psychological mess, because you're like, oh my god, am I going to lose 2% on that trade? Am I going to lose another 2% on that trade? And then I've blown the account because I'm not sticking to the parameters, or the daily drawdown's 5%. What if I'm just going over that threshold on this trade but not that trade? And then it becomes an absolute nightmare, and it becomes a mess. My best advice is, should you do it? No. How to approach it? Again, my advice is just don't do it. Don't manage risk across multiple positions, as in like different pairs. So I really, really firmly believe, don't start messing around with different pairs on the same positions, where you've got trades on at the same time. It creates a hectic environment in your head, and that's not good for any old trader. So main point in there, be disciplined. Focus on your one setup, on your one trade, on your one strategy, on that one pair for that one day. Keep it simple, keep your mind focused. Don't start creating a scatter in your head and going on to different pairs, and going on to different risk management strategies. Just be disciplined. Coming on to daily, weekly and monthly risk parameters for and against. So daily percentages, I'm going to be looking, and I suggest for the wider trader community, if you're looking to secure 1% a day, that is absolutely amazing, because 1% a day, say you're going on a nice winning streak, you need 7 1% trades, and you've pretty much passed phase 1. You just need another 0.5%. However, you could be securing a 2% trade, then you only need 3.5. So it's what Funding Frontier have done is absolutely amazing. They made it so manageable, to actually create a phase 1 and the lowest percentage to actually achieve in the whole of the prop firm space, which is absolutely insane. What about against? Risking 1 to 2% per trade is ideal. However, if you lose 2 1% trades on that day, leave it, come back tomorrow. Don't risk more than 1 to 2% a day. That's my biggest advice there. What about your weekly percentages? What are you looking to aim for? In my opinion, if you can aim to get between 3 to 5% a week, that's ideal. 3 to 5% a week, in some people that doesn't seem a lot. Some people want to get 20, 30%. You don't need to. If you're getting 3% a week on a 100k account, that is $3,000 a week, which is insane. Which then brings me on to the monthly percentages. If you get that 3% a week, you're getting 12% a month, which is more than enough. On a 100k account, 12% a month, absolutely insane numbers. You're getting 12 grand a month. Again, for the daily percentages, I wouldn't want to be looking to lose, like I've said, more than 2% a day. If you're losing 1% a day, that gives you 5 days to lose, which is a full week. And then if you're losing another 5 trades, you've got another 5 trades to lose on the next week. So again, I'll be looking to get 3 to 5% a week, and I also wouldn't be looking to lose more than 3 to 5% a week. If you are losing 10 trades in a row, I would take a look at your trading strategy, your trading plan, and your risk management plan. But in the comment section down below, if you are struggling, then always chuck a message down below. Very, very happy to help where we can. And the monthly percentages, like we said, aiming to get 10% a month, between 10, 15 and 20% a month is an absolute game changer. Which means you've already passed a whole prop firm challenge in 1 month, if you just stick to them risk management parameters, which is absolutely insane. And just before we go, guys, comment down below your favorite way of managing risk. Is it static? Is it dynamic? Do you like to add into positions? Do you like to take some risk off the table when things are going against you? Let us know down below in the comments. And lastly, like and subscribe for more trading education. Thank you for coming to watch and staying to the end. You're the real ones. Thank you very much from Funding Frontier, myself, Ryan Cruz, F.